Hello, investors. My name is Luke Boesch-Powers. I'm a sophomore at Phillips Academy in Andover, Massachusetts, and today I'm going to be pitching SciPlay. So SciPlay is a high-quality company that I believe will be able to put up stellar growth and earnings during this turbulent, uncertain time, in addition to afterward. So SciPlay is a mobile casino powerhouse. What they do is they own, develop, and operate a portfolio of these high-quality casino games. They mainly use slot machine concepts where users can play slot machines in a game environment. And they do so with virtual currencies, mainly for regulatory purposes. And for the most part, these virtual currencies are offered free of charge. However, some users choose to spend real money on these virtual currencies, which is how SciPlay makes money. So in 2019, SciPlay was awarded top social casino company by a prominent gaming analytics firm. And currently they sport 2.6 million daily active users, 7.6 million monthly active users, and their games are available on 84% of all mobile platforms. Their games are also available on computers. However, for the most part, they are active on mobile devices. So in terms of looking for a good company to invest in, Warren Buffett would say, buy commodities, sell brands. As in, look for companies that appear to be just standard issue sellers of a commoditized product, but in reality have a real brand behind them, which can produce outsized returns because of customer loyalty and related tailwinds. So how SciPlay plays into this is that they own rights to the intellectual property of Scientific Games. Scientific Games is pretty much the world's only manufacturer of real life slot machine terminals, the ones you'll find in Vegas. And what SciPlay is able to do with that intellectual property is they're able to incorporate those designs into their games so that users can experience the real scenes, the real views of Vegas at the tip of their fingers, which puts SciPlay light years ahead of their competition because users are able to actually experience the machines they know and love from Las Vegas, which, by the way, is shuttered right now and represents a significant opportunity for the company. So not only does SciPlay have an excellent product, they also have an excellent business. First of all, in 2020, they're expected to have a net income margin of 24%. That's up from 20% in 2019. Please note that all 2020 numbers were calculated by financial firms before the pandemic, so most likely they will be higher for reasons I'll get to later. In terms of growing their revenues, which is expected to be around 8% in 2020 and 2021, and they are part of a market that will grow 11% going forward to 2022. They mainly do so by, again, developing new products like you'd expect of a company, as well as maximizing the effectiveness of existing legacy assets that are very successful. And this is particularly apparent with SciPlay. Their most successful game is Jackpot Party, which was actually their oldest game as well. Meaning that as games tend to get older, they require less development and operation and can just make money for the company. We're looking at the newest game, Monopoly Slots, which still actually loses money. However, as games go farther into their life cycle, they actually make more money for the company, as you would expect of, for example, a physical casino. So just a brief history of SciPlay. They were previously owned by Scientific Games before they were spun out in IPO, where they purchased the intellectual property of Scientific Games in exchange for about 18% of the company sold to public investors. These funds were then plowed into that. Basically, Scientific Games acquired the app development assets of several slot machine manufacturers that they acquired during the 2010s era, as well as another mobile game developer, SpiceRack. So they have such a large portfolio due to these smart acquisitions. And going forward, they might be in a good position given their solid cash pile to make some more. So far I've sort of explained why SciPlay is an excellent business. And the valuation I'll talk about later is also surprisingly low. So the main bear contention, and really the only one that's feasible for such a large margin of safety, is the dual class share structure. So pretty much what's going on is that Scientific Games owns 73% of the company, but controls 99% plus of the voting power. They control these super shares that have supersized voting power. However, interests seem to be aligned, and this seems drastically overblown. First of all, they still own 70% of the company, so if SciPlay were to decrease in value due to bad corporate governance, Scientific Games still has quite a bit to lose. And this is also exemplified in insider ownership of the company. Insiders bought at the May 2019 IPO. Shares lost over 50% of their value, and most recently, in the past few months, 3 insiders have actually doubled down, purchasing shares at around $9 a piece. As of when I made this presentation, shares were trading at around $9. And I believe that's what I'm supposed to be assessed from. Third, several other companies such as Chewy, Cloudflare, CrowdStrike, Peloton have just trust the symbiotic relationship between the controlling shareholder and the public shareholders who want to play a role in this stellar company's growth and earnings, etc. And this is exemplified by a similar company experiencing very little price action to the upside after a significant change in a dual class structure was announced. So let's do a valuation case file in terms of understanding the valuation of SciPlay versus other companies, because frankly, at a 9 PE ratio, it's pretty dang cheap. So looking at it here, Zynga being another mobile game developer, although they derive less than half of their revenue from casino games. And there are also some minor differences in the companies, such as Zynga has higher growth, SciPlay has higher margins, and Zynga's net cash position is a slightly higher percentage of their market cap than SciPlay's net cash position. So out of these arguments that differentiate them, the most apparent one is that Zynga has a superior business because they derive a lower percentage of the revenues, less than 50%, from casino games. However, I will actually turn that and say that a casino game developer has a far superior business than a game developer that develops, say, a race car game. Because if you reference the graph on the bottom right corner, casino games tend to continue to rank highly and thus bring in money, bring in revenue, even after they are released, versus, say, a race car game developed by Zynga starts off hot, but then slowly recedes in popularity. And this trend of receding popularity is simply not seen in casino games. It's a terrific business. And in terms of this, I don't see why there's such a disparate relationship between these valuations due to the fact that SciPlay's business is objectively better in terms of what they sell and how they sell it. And I believe these statistics, I haven't directly talked about them, but I believe they speak for themselves in terms of this absurd difference in valuation. Just using enterprise value to earnings before interest and taxes, we can get a relative valuation of $18.59 for a SciPlay share. So going into a more complicated model, discounted cash flow, we get a similar valuation of $18.30. Mostly standard metrics were used, and the model was done relatively conservatively. The most important metric in this model, growth, as SciPlay is a technology company. Growth was modeled to be just 6%. However, going to 2022, the broader industry is expected to grow 11.3%. SciPlay is expected to grow 8% in the next 2 years, in addition to the fact that they are now able to tap into the broader casino market due to the fact that real casinos are closed. So a valuation of $18.30 for SciPlay here. And this is slightly lower than the $18.59 valuation from the relative model, so we'll use this to be conservative. So in terms of risks, number one, an economic downturn. Although right now, people are receiving bountiful unemployment insurance, where 50% of those who are unemployed are actually able to make more money while unemployed. A great tailwind for SciPlay. It's unclear if this will remain, in addition to the fact that in general, if people don't have a lot of excess cash in their wallets, it's not generally good for a consumer discretionary company such as SciPlay that relies on consumers spending extra money, which they're supposed to have. They need to have extra money. Second, not only is SciPlay somewhat reliant on consumers, but their controlling shareholder, Scientific Games, is humongously reliant on consumers due to the fact that they make gaming devices for casinos. If their business continues to stay died down, then it's very possible that they could go bankrupt. SciPlay could be taken over by a shareholder that does not have the interests of public shareholders in mind, and could create a scenario that's not ideal. You could turn that and say that it could also put Scientific Games in a position to sell SciPlay, but nonetheless, this is a legitimate risk. They also have risks in foreign exchange, which is pretty minor, in addition to corporate governance risk that I went over and sort of debunked. So in summary, SciPlay is an excellent business, very stellar business metrics. It's mispriced due to some overblown fears pertaining to the dual class share structure. Many other companies with dual class structures have thrived, and in general, incentives are aligned given the 70% ownership stake, in addition to insiders owning and buying more shares of SciPlay. And finally, valuations, there's a large margin of safety, and they point to 100% plus upside using relatively conservative growth rates. Anyway, thank you very much for taking the time to listen to my presentation. Have a good one.